The quarter started with a bang on April 2nd, when President Trump stood on the White House lawn with a placard and announced large, sweeping tariffs on US global trading partners. The initial reaction to this was aggressive and swift as markets scrambled to price in the impact to the global economy and corporate earnings. However, the market panic was short-lived, with President Trump announcing a 90-day pause on tariffs on April 9th, sparking a rapid recovery in expectations and in prices. Confidence was further bolstered late in the quarter amid a relative easing of geopolitical tensions in the Middle East. Against this backdrop, Australian shares surged to record highs, with growth-oriented sectors and the banks leading gains. International shares, led by the US, also rallied through the quarter. Initial trade concerns gave way to optimism as tariff delays and improving earnings forecasts lifted sentiment. After a volatile start, bond markets steadied, with US Treasury yields finishing the quarter where they started. Australian government bond yields declined on rate cut expectations, boosting returns. Corporate bond markets also performed well, supported by attractive yields and sustained investor appetite. In our view, the global economy is showing signs of slowing. Activity across key economies, including the US, Europe, Japan, China, appears to be softening, especially in the services and retail sectors. However, labour markets remain resilient, with unemployment at multi-decade lows, helping to support household demand and reduce the risk of a more severe downturn. Share markets have continued to climb, reaching multi-year highs, and valuations look very full. While some of this can be explained by resilient economic growth, full employment, and strong earnings, market gains have been more driven by sentiment than fundamentals, in our view. A key risk to portfolios is the potential for bond yields to rise in reaction to ongoing government deficit spending, including the Trump administration's Big Beautiful Bill, which includes substantial tax cuts and increased government spending. The minor reaction from bond markets to the passing of the Big Beautiful Bill has tempered our immediate concerns, but we still see risks to US government bonds over the medium term if no substantial action is taken to address the deficit. Although markets appear calm, we remain cautiously positioned, with equity valuations high and the economic outlook uncertain. In this environment, we continue to favour a diversified, quality-focused approach, and we maintain our preference for Australian bonds supported by the country's relatively strong fiscal position.